Equity markets trying to regain their footing ahead of a big week for big tech. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Sonali Basak. We're kicking you off to the closing bell here in the United States, and we are in the green. We're actually quickening up that gain today in the S&P 500, up about 1.2%, near the highs of the day. The NASDAQ 100 up even more, about 1.4% on the day here. Interesting, in the bond market, yields down only about 1 basis point. On the day, you saw that bid in the bond market start to cool off. Critical week of PMI and PCE data ahead of that Fed meeting next week. Look at gold here. So interesting. You're seeing a 2.7% decline, really taking the foot off the gas of that haven trade. You're seeing risk on all around, Romaine.
Yeah, definitely. That haven trade now fading just a little bit here. The geopolitical jitters that we saw last week really giving way today to some semblance of optimism around earnings, with at least 180 S&P companies scheduled to report this week. That includes 4 of the Magnificent 7 companies, with Tesla on Tuesday, Meta on Wednesday, Microsoft and Alphabet pulling up to the curb on Thursday. Now, according to Bloomberg Intelligence, profits for the Mag 7 are projected to show a 38% increase for the first quarter from a year ago. That dwarfs the overall S&P's 2.4% projected gain. And there is opportunity, a potential change in narrative centered around corporate fundamentals that could staunch the declines that we've seen for 3 straight weeks on the S&P 500. Not everyone is so plus, though. Jonathan Golub, the chief U.S. equity strategist at UBS, cutting to neutral his sector recommendation on the big 6 tech firms: Alphabet, Apple, Amazon, Meta, Microsoft, and NVIDIA. He cites difficult comps and cyclical forces out there that shows, well, a slowdown in earnings momentum, but mainly for the large mega caps. And that is key because he sees a rotation afoot into mid-cap tech, and that is a rotation that could be disruptive in the near term, but longer term should support further broader market gains. Golub standing by his outlook for the S&P to reach 5,400 by year end. Now, one thing aiding the big cap tech stocks this earnings season versus the last earnings season is the recent sell-off. That did reset valuations to more palatable levels. Last week's slump, that left tech stocks underperforming the S&P by the biggest gap going back to 2009. And Sonali, the NASDAQ 100, which was trading at almost 36 times earnings just about 2 or 3 weeks ago, now down to around, 31 times earnings, which I guess some people can take.
Yeah, let's talk more about those valuations here. How much have we really reset, Romaine? Because valuations sure have cheapened. But if you broaden out the aperture here, information technology, the largest sector in the S&P, is still riding above its 5-year average and above the S&P 500 at large. And investors are hoping that not only will these multiples be an attractive entry point, but drag up that index more broadly. The sector's trading, as you said, about 31 times earnings, and that is up from that 20 times their trailing 12-month earnings in the dog days of 2022. You still have the S&P, Romaine, trading just above 22 times earnings.
All right, as we kick you off to the close here on this Monday afternoon, a look ahead to the week where we are going to start to get a lot of those big tech earnings. Stefan Slowinski joining us right now. He's the global head of software research over at BNP Paribas Exane. And Stefan, everyone has sort of looked at these companies as kind of the ballast for this market. As much as we kind of see folks trying to rotate into something different, the cash generators still fall into this space here. Are we going to continue to see that type of dominance that we've seen over the past few quarters?
Yeah, hi, Romaine. Thanks for having me. And I think it's important to differentiate within the Magnificent 7. So, when we're looking at more the software side of things with Microsoft and Meta and Alphabet and even Amazon, these companies are still trading on relatively reasonable valuations, obviously have very high cash flows. And they're all taking steps to deploy that either through CapEx to generate future returns. We also think we could see a lift in buybacks. We should maybe get Alphabet with $60 billion this quarter, this week, maybe even Amazon announcing one, and even some new dividends coming through. So we're starting to see more of that cash flow, coming back to shareholders, which is also helping valuations.
What are you going to mainly be looking for out of this batch of earnings here? It's not just about the numbers. I know there is a broader narrative, whether it's around AI or some of the other big tech transformations taking place here. What's going to be most important to you?
Yeah, I think this week investors are going to be focused on 3 things. One is cloud computing. I know we talk about it every quarter, but Microsoft Azure, Amazon Web Services, Google Cloud, are they continuing to reaccelerate? Are we seeing that AI demand actually coming through and that CapEx converting into revenue for these companies? The second thing is on the digital advertising side. We saw better data points as we went through the quarter. So we're going to see that reflected in Google and Meta's numbers. Those fundamentals are important because growth will slow. Comps are getting tougher. So we want to make sure that the fundamentals are still intact. And the third thing, as I mentioned before, is capital allocation. Are these companies still being prudent about investing? Are they going to be paying more in terms of buybacks and dividends? And could M&A creep in? We've heard a few reports, obviously, from Alphabet to Salesforce considering M&A. Is that something that's really on the table?
What do you think is setting the stage for the biggest rooms for surprise? You know, we were talking about valuations here, Stefan, but the reality is you can look at it two ways. Either it's cheapened enough for a buying point into these earnings, or they're fairly valued after that sell-off. What is the starting point?
Yeah, I think there's a couple things to focus on. You know, the first thing is just the healthy of the demand environment. So we just completed our quarterly BNP Paribas software reseller channel checks. Demand appears to be what we would call rolling along the bottom. Not really getting much better. It's not really getting much worse. It's kind of, you know, way down on where we were at the beginning of 2022. But are we seeing more signs of green shoots coming through and things may be improving as customers start to look out, you know, towards those potential rate cuts coming? And then secondly, like I said, on the efficiency front, how serious are these companies about sticking to it? We think these companies are operating a kind of one in, one out policy right now, which is they are still hiring, but they're also still being prudent and they are still trimming in places. So investors are going to want to see that, you know, they'll be prudent on these investments and margins will continue to come through.
While you have such a focus on earnings this week, we have to remember that we are still a week and a half away from a big Fed meeting as well. Are any of these stocks immune to a higher for longer interest rate environment, or do you still see them as highly vulnerable to it?
It's interesting that, you know, despite the IGV, the software ETF underperforming this year, you know, we've gone from expecting 6 or 7 rate cuts to maybe 2. And despite that, you know, we still have Google up 10%. We still have Microsoft up, you know, almost 10%. So I know there's been a bit of rotation in the market, but, you know, these companies at least have demonstrated that they can continue to perform, partially because you still have reasonable free cash flow yields from some of them. I think the Fed cuts and you know, the anticipation of where rates are going are weighing a bit more on some stocks like Snowflake or Databricks or MongoDB. You know, more of that kind of unprofitable side of things, especially when you take into account stock-based comp. So they're going to be a bit more sensitive to any disappointments there on the rate side.
And finally, Stefan, how much does some of the dollar and FX headwinds at all play into this? We've seen a couple of companies already report and basically say, look, this has been an issue for us given the renewed dollar strength. Is this something that could be a factor as well?
Yeah, absolutely. And something people, as you said, are just starting to talk about, Romain, which is as we get into Q2 and Q3, we could see the year-over-year headwind from the dollar. These are global companies. They all have more than 50% of revenues outside the U.S. So, you know, you talked a bit earlier about earnings growth. A lot of these companies had big restructurings in the first half of last year, lots of charges. Obviously, this year you don't have that. So, you know, we're getting the big earnings growth this year off of those big restructuring charges last year. You don't get that going forward from here. You also could see some FX headwinds, as you pointed out. These are a bit mechanical in nature. What we're really looking at is the strength of underlying demand, and that appears still to be quite healthy.
All right, Stefan, got to leave it there. Stefan Slowinski, BNP Paribas Exane, helping to kick us off to the close here on this Monday afternoon as we look ahead to some of the big events this week and a big bill that still needs to be sorted out. Divest or ban legislation clearing the House of Representatives here in the U.S., now heading to the Senate as TikTok prepares to take it to the courts. Full coverage up ahead.
Plus, we're looking at crypto stocks on the rise after that Bitcoin halving. We're going to speak to Anthony Pompliano, founder of Pomp Investments.
And with stocks rebounding here, the NASDAQ up 1.5%. A conversation up ahead with JoAnne Feeney, partner and portfolio manager at Advisors Capital Management, as we count you down to the close. This is Bloomberg.
Season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead is coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Now, in the coming days, the Senate is expected to vote on legislation requiring TikTok's Chinese parent company to divest its ownership stake in the app. President Joe Biden, for his own part, has said he will sign the legislation promptly. For more, let's bring in Bloomberg's Alex Barinka. Alex, I've been watching your coverage so closely over the weekend. TikTok has been coming back with fighting words. How can you expect them to really fight the legislation, and do they have a ground to stand on?
They have been, and they started that fight back with their users. They put another option for users to enter in their zip codes and call their senators to try to stop this incredibly fast-moving bill that's tied to these Ukraine and Israel aid packages that at this point, Sonali, is basically almost inevitable in its passage. So they've gone to users, they put their VP of policy in front of TikTokers, news TikTokers, to try to get their message out there. But truly, this is going to come down to what happens after this bill gets signed into law. ByteDance, TikTok's Chinese parent company, and TikTok do expect to take this to a full-force legal battle. According to a person familiar that we spoke to over the weekend, the company thinks that they could get as long as a one-year injunction, a restraining order on this legislation, and wage that legal battle in the courts. So while we might see Joe Biden signing off on this law as soon as this week, this back and forth with TikTok and the U.S. government certainly will not be over.
I'm curious, though, if there ends up, Alex, if there ends up being kind of ramifications prior to that, even if they are able to sort of stall this for a while. A lot of people are looking at this and saying, okay, if they end up going away, I need to find another place. I'm talking about the users on the platform, and for that matter, advertisers as well. Have we seen other social media platforms potentially benefit from this, whether it's, Meta and its platforms or Snap or something like that?
Yeah, so TikTok basically revolutionized how social media does business. With that really powerful algorithm, they made it more about what you're interested in and not just who you're following. So that means the likes of Instagram and even Alphabet's YouTube have already copied some of the core features of TikTok. So when I think of places like YouTube, whose YouTube Shorts looks like a TikTok feed, or Instagram Reels, those are places that I've heard from both users, creators who build their businesses on TikTok, and merchants who are now selling on the young TikTok Shop e-commerce offering that TikTok rolled out in the US. They're all looking at their options and saying, hey, I have a bottom line to meet on my own. I better start diversifying and figuring out where else I can meet people outside of just the TikTok app, just in case this company does cease to exist in app form in the US in, say, a year's time.
You know, it's interesting, kind of alarmingly quiet in the last couple of weeks is Steven Mnuchin, where there's been a lot of conversation around whether he could come in and be sort of a white knight here in terms of any sort of deal. How would that change the conversation around TikTok and the way it operates in the United States?
I think that if this does come to some kind of divestiture, which could be a sale or a kind of spin-off, the government hasn't specified what would make them happy. I think Mnuchin would be among a number of people who would line up behind TikTok. This is an incredibly valuable asset. 170 million users spend hours on average a day here in the US, and they love that asset. But ByteDance, according to people familiar with the matter, and potentially the Chinese government, wouldn't want to necessarily give away the gem of TikTok, its algorithm. So as this gets down to decision making, if this is signed into law, of what happens next, if a divestiture is forced by this legislation, I think the biggest questions for Mnuchin and others will be, what does U.S. TikTok look like? And does the algorithm actually come with it to whomever ends up being the majority owner if it's a divestiture and not a ban that happens for this app?
All right, Alex Barinka covers social media for us out there in Los Angeles. On the back, Sonali, of that approval over the weekend, the House of Representatives approving that TikTok ban as part of a broader legislative package. Most people assume this is going to make it through the Senate, and the president has already said he'll sign it. But to the point of who's going to buy this, you bring up Steve Mnuchin. I was looking at it. They're saying that TikTok overall, the global TikTok, is valued somewhere around like $300 million. Even if you take off the U.S. portion of that, you're probably talking like $50 billion, maybe even more than that. There are a lot of people that can afford that.
Massive deal. That would be. You need the investor group. You need the financiers, right? Is the money there in the bond markets to help finance the deal like that? It's interesting. And in the near term, Romaine, you see Meta, the shares are up 37%, and the earnings, I'm wondering how much you'll see that advertiser shift starting to take hold. That's the bet that's being made in the market here. here, isn't it?
I think that's going to be really critical, too. And then also to Alex's last point, too, if all this is about the algorithm and China doesn't want us seeing that algorithm, because let's face it, we don't know what that algorithm is, it raises the question, what's the value of it without that algorithm?
You know, Manus Cranny gets a lot of views on TikTok these days of our own rights.
Sure,
so I'm also curious about what is in that algorithm.
Manus is quite the character here. We have a lot of characters here on Bloomberg Television. We'll have a couple more coming up in just a bit here on the program as we look at some of the big movers of the day. Spotify shares on the back foot ahead of its big earnings tomorrow. A conversation with Tim Nollen over at Macquarie. That's part of our top calls. That's up next on The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start with CNH, the tractor maker. A downgrade to neutral over at Bank of America. The primary reason being that sudden CEO change that caught a lot of folks off guard. Analysts say it adding a lot of uncertainty right now around the company's transformation. In their view, the departing CEO, Scott Wine, his vision was actually starting to bear some fruit. Investors concerned as well. The shares down 5.5%. Next in line, Papa John's. Stifel upgrading to hold from sell, saying despite past controversies, Papa John's is still the mainstay in the pizza market. The analyst likes the company's new advertising and marketing initiatives, though does warn that the additional national media spend will only meaningfully improve comps if the company hammers home a compelling price value message. Some investors finding value today. The shares up by about 0.6%. And finally, let's take a look at Spotify. A high note today over at Macquarie as the price target actually getting bumped up to 330 from 300. The analyst there, Tim Nollen, encouraged by the company's U.S. price hikes, improving ad market trends, and the appointment of a new CFO who will complement the company's renewed focus on profitability. Those shares fractionally lower on the day, and those are some of our top calls. All right, now we do want to stick with Spotify and the man who brought us that last call, as the company is expected to report earnings tomorrow. Tim Nollen is senior media tech analyst over at Macquarie, and he still rates the shares outperform. All right, Tim, let's get right to it here. I mean, what are you expecting here? We've actually seen a lot of improvement, particularly on the profitability side here. Is this about growth or is this about profitability heading into this earnings report?
Yeah, hi, Romaine. Well, we like Spotify for both. It's interesting is the bigger Spotify gets, the faster it grows. We're looking at revenue accelerating to high teens in Q1. But really the most important thing, the number one topic that's been on investors' minds for years, I think ever since Spotify went public, is when will it actually get to profitability? The guidance for the quarter for Q1 is of operating margin of about 5%. I think consensus is below that. So the street doesn't actually believe that they're going to be able to get into profitability. But I think they're on a path to sustainable profitability. If they can get into mid-single digits profitability, not just for Q1, but for full year 2024 and beyond, and consistently every quarter, I think there's still a lot more upside to the stock as investors finally get comfortable with the prospect of Spotify being a profitable company.
As part being a part of a profitable company, we've seen Spotify really trying to diversify a little bit, not just music, but audiobooks, and of course the big initiatives that they took in podcasting. But at least based on a lot of the reporting Bloomberg has done, those businesses aren't necessarily profitable yet. Do you see those being a real complement to the business longer term?
Yeah, well, definitely. This is how Spotify intends to get to profitability. And I think, importantly, the podcasting business finally can inflect into positive territory itself, which can bring the whole business into profitability. You know, the music labels certainly maintain bargaining leverage over Spotify in terms of, you know, the price that they charge. Or the cut that they take, I should say, from the listeners. So Spotify will not get bargaining leverage on the labels, but there's a whole other business. I forget the number, but it's in the teens of total listenership. Toward 20% of total listenership of Spotify is of podcasts. Podcasts are businesses that Spotify either owns or they pay a license to somebody to have that content on their platform. And with so many users, we're expecting north of 600 million MAUs, or monthly active users, for Spotify in the quarter. You've got all of this listenership of podcasts That's where the company makes its money on the advertising side, and that's not a cut that goes to the labels because it's content that they own or can monetize. So getting podcasts and eventually then audiobooks into profitability really is the path for Spotify.
How do you think about Spotify's relationship to its customers, particularly given price increases? At what point does that cause a dent?
Yes, Spotify did raise price by $1 in the U.S. In the fall of this past year. I believe there might be more price increases to come in some other developed countries in 2024. But Spotify had the same price for however many years, over a dozen years since entering the market, and I think that was because they didn't feel they had the wherewithal to make that increase when some of the major platform players out there, Apple and Amazon, were keeping their prices intact. With those prices going up and the labels absolutely encouraging Spotify to raise price, I think they finally had the confidence to do so without feeling that they were going to lose subscribers or going to incrementally bring about any more churn, because the major platforms that they compete against were doing the same. So it's an important driver of course, revenue growth, but I think also profitable growth for Spotify.
How do you think about success when it comes to some of the areas outside of traditional music, podcasts, audiobooks? When you think about audiobooks in particular, people go elsewhere currently for that. Do they need to be spending significantly to expand that base, or is a lower bar a level of success for you?
Well, for me, a lower bar is a level of success. I don't know myself how big a business audiobooks can be. Spotify certainly seems very enthused about it. But you could have said the same for podcasting, 8 years ago or so when they started moving into this area. And it was an industry at the time that was not very well understood, not very well recognized by investors, and consumers just began to use it more and more. And as I said, it's a decent sized chunk of total Spotify listening now. So they're bulled up about the prospect of audiobooks. I don't think it has to be a major driver of revenue, a major piece of their business going forward, but as a complementary element to a platform service that gives listeners, consumers more and more things to go to Spotify for and to stay on Spotify on. I think it's an extra piece of driving consumers, reducing churn, and helping profitability.
Thanks to Tim Nollen of Macquarie, who had that recent call updating his price target on Spotify. It's interesting, I was just looking here, Romaine, about how many people are actually using audiobooks on Spotify, and it's been at least a quarter.
Yeah.
And so, early signs of success there at least.
Yeah, absolutely. Here.
Now, coming up, we're going to talk to Anthony Pompliano. We're going to switch from Spotify to Bitcoin halving. We're going to talk about crypto adoption next. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Sonali Basak. Romaine, on a day where some of those animal spirits seem to be back.
Yeah.
Right ahead of earnings.
Well, look, you talk about the big sell-off, and maybe that was the perfect setup, right? Sort of clears the deck, at least on some of those valuations, and gives people maybe an excuse to kind of reset here for what we get ahead of that. But it's not just equities.
You have to worry if it's, though, buy the rumor, sell the news on this one.
Absolutely. But it's not just equities either, right? You take a look at Bitcoin. What was it, last week or a week and a half ago? We were down around 60,000, and you get a nice bump back up. 66,000 today, Sonali.
66,000, but still off those highs. Let's take that contrarian view, too, taking a look at Bitcoin climbing following the weekend's halving. Remember, the halving cuts the number of Bitcoin produced daily in half. We're going to discuss that more with Pomp Investments founder Anthony Pompliano. And I think you sit here on a Monday, calm after the storm, and you wonder, did it work? The halving worked, but did it really create that catalyst for crypto that everyone expected?
Yeah, one of the things that everyone wants to see is like the halving occurs and a minute later, all of a sudden the price goes up or down or sideways, what's going to occur. But what we've seen historically is that the halving does take some time to kind of work in. There was great research that came out of Bitwise, and what they showed was in the month before the halving, the average return over the last couple of bull markets has been 19%. In the month after the halving, it's been 1.7%. So you'd say, if I look at it as a 30-day before, 30-day after, it doesn't really matter. But if you actually look at it over a longer time frame, let's say 12 months or 18 months, the halving has marked a point where then we go up. And so it's just classic economics 101, right? If demand stays the same and you take away half of the incoming supply, the price has to adjust up or down to accommodate everyone. I think that this time won't be any different.
You have to wonder how long the halving kind of works as a monetary theory, if you will, and a way to control the supply of Bitcoin. To your point, if demand stays the same, but at what point do you know that demand will continue at the same pace that it has? We've already seen a lot of those flows into the ETFs start to moderate.
Yeah, what's interesting is that Bitcoin, actually, the demand in terms of aggregate dollars is actually going up. And so what you would look at is you say, oh, there's lots of people who already own Bitcoin. Who else is going to buy Bitcoin? Well, the biggest pools of capital are still left. And so if you look at some of these large sovereign wealth funds, et cetera, the ETFs introduce a way for them to actually get price exposure without taking control of the Bitcoin. So you can imagine there's certain countries around the world that if all of a sudden they were buying Bitcoin, taking self-custody, people would be asking some questions. Why are you doing that, right? Why are you taking your central bank reserves and getting it out of these other assets that the U.S. likes you to have it in? And so I do think that the ETFs will allow that price exposure. There are sovereign wealths that are going to go ahead and allocate to it. The question is just how much higher will Bitcoin go in this bull market? And that's what everyone's trying to figure out.
There was a lot of talk before we sort of ended up in this new bull market. There was a lot of talk about regulation, right? Of course, you got whatever the SEC was trying to do. And then you had other regulators across the world basically trying to clamp down on this. You don't really hear about that much anymore. I think they kind of feel like, well, we've put out our proposals and, that's the best we can do.
Yeah, so I think that Bitcoin is the first asset that's kind of gotten through the regulatory gauntlet, right? Mm-hmm. And regulators around the world say, hey, this is not a security. This thing is kind of a digital gold, and we're okay with that and going to treat it that way. The other assets very much feel like they're still in the gauntlet, right? And constantly there are regulators both in the United States and elsewhere trying to figure out how to classify these things. Mm-hmm. The nice thing about the United States capital markets is that usually the regulators figure it out. It may be tumultuous on the way there, but eventually they will reach some agreement and they'll all treat it the same way. And that'll provide clarity for people to go and start building in this industry in a way that I think is conducive to what we're trying to accomplish in America.
I know some of that regulatory risk has shifted away to Bitcoin, to some of the other digital assets, but there's also been a lot of talk about maybe a potential upswing for some of those assets as well. The idea that they haven't necessarily participated in the rally to the same extent as Bitcoin.
One of the most interesting things that people kind of wake up to coming out of the crypto world is there might be more degens on Wall Street than there are in the crypto world, right? If you say to someone, hey, you can get 10x leverage, if you say that there's 100x opportunity, there's a lot of people in suits and ties that are going to pay attention. Yeah. And so I do think that we like to have a black and white world and say, oh, like all the risk takers over here in crypto, all of the smart money is on Wall Street. But naturally, there are just as many risk takers, if not more, on Wall Street. And so what I think is now going to be a big narrative going over the next 12 months, how do those investors get access to those assets, right? And so you're going to see altcoin ETFs. You're going to see them start to create all kinds of different funds in the private markets, closed end, open end, et cetera, where they are going to try to get at these assets that they believe are asymmetric because they want returns. And there's not that many returns in other asset classes.
Anthony, I know you invest kind of across asset here. Do you think that at this point you would put more money into Bitcoin versus the big tech giants? Or do you start to take some chips off the table in Bitcoin as somebody who's been a traditional crypto investor and invest in normal way markets? I mean, which is a better risk asset to you at this point?
Yeah, there's a really interesting bifurcation that's occurring. If you're optimizing solely for return, I think people will continue to allocate to Bitcoin and cryptocurrencies because they see it as a more asymmetric asset. It's got a bigger tailwind, more capital flowing in there. One of the things that people are not talking about yet, though, is people in the crypto industry who have built wealth up, when they go to a bank and they want to get a mortgage, they want to get some sort of loan, et cetera, the banks write their crypto assets to zero. And so now all of a sudden, if you show up and let's say you have $10 million of crypto and you have $100,000 in the bank says you're worth $100,000. And so what I do see a lot of people in the crypto world is they're starting to diversify slightly, not a ton, but slightly, because they're trying to actually say, look, I'm going to get married. I'm going to get kids. I'm going to try to buy a house. I got to go kind of live my life. And so I think it's going to be very interesting. The wealth generation in crypto starts to seek into these other asset classes.
And can they do that, though? Can they sort of provide that without actually giving up control or basically giving up ownership?
So this is where we're never going to have a competition, right? Yeah. Obviously, the legacy folks, if you go talk to the banks, their official position is, hey, we don't touch those assets. The younger people in the banks, they want these people to be able to interface with their financial services, et cetera. But right now, you've got to sell the crypto to be able to get fiat or kind of traditional assets put into the bank. Yeah. What I do think is happening, though, is there's people in the crypto world who say, well, why don't we just go offer those same financial services and we'll touch the crypto. You won't have to sell it. And I think that's where the competition is going to be. Will the old incumbents win or will these new players come out on top?
All right, Anthony, great stuff. Anthony Pompliano, Pomp Investments founder here, talking about, I guess, the longer-term prospects for Bitcoin coming off of the halving. Another story, though, in this space, Sonali, that actually caught my eye, if you want some idea of just how much this market has gotten. Did you hear about this sign that is going up for auction?
You actually...
So somebody was sitting behind Janet Yellen at this last big briefing that they had and held up on a legal pad a sign that said, buy Bitcoin, just scrawled on there. This thing is now being auctioned off at a starting bid of $140,000.
I think.
Am I missing something here?
No, you are not missing something. But I think what's being missed here is the fact that this sign.
There it is, right there. It's not even signed by Janet Yellen. Now, if she signed it, I would pay $140,000 for it. Well, or maybe if it was signed by the guy holding it. I don't know.
Right, because I think the point is that it's not signed by Janet Yellen, isn't it? But I mean, the fact that
is it signed by Satoshi or something?
Well, you know, it's funny. Somebody over the weekend was like, "Why is there so much faith in something that we don't know who created it in the first place?" But again, that's the point, isn't it? But
are you talking about the U.S. dollar, or are you talking about Bitcoin?
I'm talking about Bitcoin. But you know what? That's a good point. But the fact that the sign alone is worth multiples of what Bitcoin per Bitcoin is worth is a signal of kind of derivative effects about the idea of Bitcoin, at least.
Yeah, I'm being a little facetious. Great story on the Bloomberg terminal. And by the way, the guy holding up that sign, Christian Langelis, he was a 22-year-old at the time who owned Bitcoin and was an intern there in Washington. All right, coming up here on the big program, I'll look at some of the movers on the day, and that includes Salesforce. We are learning that it is no longer talking with Informatica about a takeover bid. That's our stock of the hour, and it's coming up next. This is The Close on Bloomberg. Time now for our stock of the hour. Informatica is saying that it's not engaged in any takeover talks. That's after multiple reports that it was in discussions with Salesforce. Those reports now saying that those discussions have cooled. See Salesforce shares up about 1% on the day. Informatica down 11%. Abigail Doolittle joining us right now for more on our stock of the hour. All right, this was a scuttlebutt really for the last couple of weeks here. And most Salesforce investors didn't like this when they first heard it. I think by the share reaction today, the fact that those talks might be off seems to be pleasing.
Yeah, it does. We have the stock higher by 1%. And when we first received the news that Informatica was out, the stock was up more than 3%, the best day since February. The reasons that they did not like this deal, first, Mark Benioff, the CEO, last year said that they were not going to be doing M&A, that they were going to take a breather there. Second, they bought MuleSoft, a competitor, not so long ago. So it was like, why do they need Informatica? And then Informatica is growing 6 to 7%. Salesforce is growing more. So what was the point? Now, it's so interesting. We were just taking a look at that Informatica action, down, as you mentioned, 11% on the day since the deal was first speculated about, down more than, I think, 15, 16%, almost a bear market, the worst stretch since October of 2022.
Yeah, the shares are actually below where it was when this first sort of started bubbling up.
But what's so interesting about it is the stock sold off when the deal was speculated last Monday for the first time, and that was because the price that they were talking about was going to be less than what Informatica was worth. But now we still have the stock selling off. So Informatica investors, they can't get it either way because it's interesting. I mean, Informatica today tried to reassure guidance is okay. We're at the high end of subscription for the current quarter. Yeah. But nonetheless, it seems like those Informatica investors, even though they were going to take a price that was less than what Informatica was trading at when the deal was first speculated upon, they wanted that deal.
Abigail, what does this say about software M&A? Because if you're seeing Informatica really sell off, even despite that kind of optimism there, does it mean that investors are really clamoring for these smaller software companies to be selling to the giants, even if the giant investors don't love the idea of M&A? Is it Salesforce specific that they didn't like that idea?
I think that's a great question and a great point. So Gartner is out with some research earlier this year saying that due to the macro ambiguity that within technology, smaller companies are going to want to be acquired, but it comes down to the big companies. Do they want these smaller companies? You know, also we can take a look at it in terms of the macro because we have the Fed, we have geopolitical. Right now we have earnings. That's sort of a smaller pressure. But we had these kites in the sky. The kites have come down. Is it because of storms down the pike that these companies are seeing, or is it just because this deal didn't make sense? All of the reasons that they were protesting the deal, that was even before antitrust potential issues.
Is it also kind of a matter of use of capital here? If you're an investor, would you rather see buybacks and dividends rather than spending a lot of money
especially
on
in
deals?
a case like this stock where, again, Informatica growing at 6 to 7%, and then you have Salesforce.com growing in the teens. and they already have it. MuleSoft apparently.
That's really the nail you have to hammer harder here, because I think when it came out, that was the first thing. Why would you buy a company that's clearly growing less than? Was there something else strategic there? They certainly didn't articulate.
They didn't articulate it.
If there was, and that leads investors to say, why are you going to pony up all this cash and maybe even debt to do this?
Yes.
Yeah. All right, Abigail. Thank you. Abigail Doolittle there with our stock of the hour. A closer look. Salesforce shares up about 1%. Informatica down about 10% here, Shonali. And I think it does get to that broader question, too, about M&A. I mean, companies like this are always going to be in play, these sort of mid-sized software companies here. But again, there has to be a compelling reason as to how it fits there. And I know that all these rumors are sort of fueled by the media rather than Salesforce itself. But at some point, you want Salesforce to say, OK, here's why this actually matters to us.
Yeah, and it's funny, we were talking about the scuttlebutt behind the scenes. Sometimes bankers love the leak because you get to see the reaction. And then when the reaction is not so good, everyone loves the leak a little less. But what's interesting here is the difference between the Wall Street dream of M&A coming back and investors. What do they really want? Do they want those buybacks, or do they want them to, frankly, these deals require leverage a lot of the time too. Do they want to be paying for that debt? It's cheap now, but does it stay cheap?
Yeah, and of course you need a more stable environment, some stability today here in the yield space, basically unchanged across the board on treasuries. The VIX tamped down, the dollar not doing much of anything, and of course you see the big moves, Shonali, in the equity space.
And we're going to talk more about the equities and the debt space as it's moving. JoAnne Feeney, partner and portfolio manager at Advisors Capital Management. She's going to be joining us. This is The Close on Bloomberg. Stick with us.
This is the countdown to the close. Romaine Bostick alongside Shonali Basak with about 10 minutes until we get to the closing bell. Shonali, a big difference than what we saw on Friday afternoon with stocks selling off. Green across the screen.
Green across the screen. You're looking at the S&P 500 firmly back above that 5,000 level. We were up more than 1% on the day. Broad-based gains, though. We're just under that 1% level. The NASDAQ 100 up still more than 1%. The two-year yield, you're looking at a 496 handle. Interesting. People are watching earnings so much, Romaine, that they forget we still have a little more economic data this week. PMIs tomorrow, PCE later this week, to really put a nail in that coffin of that risk-off mode for the start of the week at least. Is gold on the decline back again. Of course, that has been the big winner of the year if we look at the cross-asset boards. But again, if you look at the S&P 500, it's really energy and communications leading the way on the year.
And of course, this is going to be a big week for earnings. About 160 S&P 500 companies are scheduled to report this week, including some of the biggest of the big. That includes Alphabet, that includes Tesla, and that even includes Microsoft. And a lot of questions out there right now as to whether some of those large cap names and large cap tech names can help push this market higher. JoAnne Feeney joining us right now. She's partner and portfolio manager at Advisors Capital Management, joining us to help count you down to those closing bells. And I do want to start there, JoAnne. There was a lot of talk heading to this earnings season that now that we kind of have some clarity about where the Fed stands, and maybe now that we know that some of the geopolitical issues are, if not resolved, at least contained here, that this earnings season and the reports that we get and the commentary we get out of some of these companies is going to matter much, much more for where this market goes next.
Yeah, Romaine, I think that's exactly right. And the Fed has really, pulled back a little bit as a driver here for the market. Finally, investors have recognized that the Fed is serious about trying to reach its 2% target, and it's going to do what it takes to get there in terms of keeping those short-term policy rates high, and that's what we're seeing in the bond market. But what we also saw, particularly in the first quarter of the year and the end of last year, was the market moving in advance of earnings this year. After last year's really weak earnings year, we are seeing a bounce back this year. We're starting to see it already in the numbers for the first quarter, and we expect to see more. And so the market moved up quite a lot in the first quarter, if you remember, it was 10%. And now it's pulled back some, saying, okay, wait a second, maybe we got a little bit ahead of things. The Fed's not going to step in as soon as we would like. We better be a little bit more circumspect and more selective in the stocks we choose to own at this point.
Well, let's talk a little bit about that, because the past earnings season that we had, it was interesting to see kind of the differences. You had some of those companies that were much more dependent on corporate spending, enterprise spending, seemed to still do well. Those companies that were a little bit more tied to the consumer and the economy and cyclical economic trends didn't seem to do as well. Are we going to see a repeat of that this time around?
Yeah, we could, Romain, because what we're certainly seeing in the data is less of a reason to be enthusiastic about the strength of the consumer. I mean, clearly, the consumers are running through some of the savings they built up during the pandemic. We've seen credit card balances rise and interest burden rise, although still in a reasonable place relative to income, so we shouldn't be alarmed. But we probably don't expect the consumer to be as strong. One place we like to go to, though, is look for structural growth, look for the long-term technology plays, which is why they did so well at the end of last year and the beginning of this year. It's because that's where the growth is. And that's where investors want to be, at least the ones that have a long enough time horizon that they can own something like a Microsoft, an NVIDIA, an AMD, and a Google and wait out these bumps in the road.
Well, the question for those types of stocks, those tech stocks in particular, how immune are they to some of the potential headwinds, higher interest rates than investors initially expected, and even geopolitical risk? These are the things, JoAnne, that have really thrown a wrench in the optimism in recent weeks. Can those stocks really ride through any uncertainty?
Sonali, I would say eventually. As I said, if you're a long enough term investor, you can ride out the bumps in the road that do come from geopolitics, that do come from interest rates. Notice, though, that interest rates now are probably near the peak of where they're going to be, right? Yes, there's still some pressure on the labor market. Yes, there's still certainly some stubbornness to inflation. But it's, even if the Fed doesn't cut rates anytime soon, they're probably not going to raise rates. So we're probably near at least the top of the interest rate cost to doing business. And that has been a headwind for growthier stocks. We shouldn't expect that to be much of a headwind, if at all, going forward. In fact, eventually we should get the tailwind of rates coming down, of the cost of business in terms of borrowing and investing in new projects coming down. And so that should be good for the growth stocks, even though some of those risks that you talked about are still going to be in the background.
How do you see any potential opportunities in and around this earnings season? Are you looking for more opportunities to buy at this point, or are you looking for any signs of weakness to be taking chips off the table?
Yeah, it really depends on the strategy. And as you know, we're long-term investors for our clients, and we're selecting individual stocks and bonds for them. We're looking for areas where we expect two things to happen. One, growth to continue. Again, that can be a longer-term play, but also for some of our clients, we want to build in some resilience in the form of income-oriented stocks like an AbbVie or a Raytheon, and then ones that also bring some defensiveness to the strategy to create some diversification against some of those geopolitical risks. So it really depends what we're trying to accomplish, and that ultimately depends on the client and their needs.
So kind of wrap this up for us, JoAnne, in the sense that once we get through this earnings season, we still have a lot of other catalysts that this market is going to have to deal with, whether it's the unresolved geopolitical issues, a big election, of course, coming up here in the U.S. in November here. What is kind of the general advice that you give clients in terms of navigating that? Is it just kind of ignore it, stay the course, or is there something tactical they should be doing?
No, I think you have to update, right, your views of what those risks are and how best to position the portfolio, again, depending on the goals. But right now, we certainly have seen an elevation in the geopolitical risks, whether it's China, Middle East, or Europe. And that has triggered some changes in how we allocate across client portfolios in terms of trying to build in some diversification, build in some extra income, perhaps, and even, trying to determine how much clients ought to have in bonds versus equities because of that increase in risk. But, shorter term tactical moves really aren't as useful. As you know, trying to time the market is awfully challenging. And so what we prefer to find is areas where there are, say, shortages, where there's structural growth, where we think they're going to do fine in the long term.
All right, JoAnne, going to have to leave it there. JoAnne Feeney over at Advisors Capital Management, helping us count you down to those closing bells. Just about 3 minutes to go here with stocks in the green across the board. All 11 S&P sectors are also in the green, led by big tech. But I was taking a look at some of the individual movers, Sonali. It's actually pretty broad-based here. I mean, the two biggest gainers in the S&P are travel stocks. Well, actually, let me rephrase that. One is United, one is Ford. I guess Ford's technically travel or transportation.
Well, I'm so interested in the Ford outperformance today versus Tesla, which is one of the biggest losers in the S&P 500. And you have to see if investors are starting to go back to basics a little bit here, kind of rewriting the narrative around, what is technology and what is transportation.
Yeah, and I think a lot of investors really looking for, you can talk about the basics. It's really, what do those bottom line numbers look like? What does cash flow look like? It's not just about that broad narrative, the sizzle, more than the steak. All right, stick with us. We're about to take you to the bell and beyond.
Be Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Sonali Basak. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast with Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms. That includes television, radio, and our partnership with YouTube. Happy Monday, Carol Massar. I hope you had a good weekend because the market's doing well.
Yeah, I mean, the bulls are back in a big way. And you look at the major industry groups, we'll get into it later. But, there's green across the screen. So we're seeing really a broad-based rally on this money. Very different tone than we've seen, certainly on Friday, but really over the last 3 weeks.
Just a reminder of where we are, though, so far this month, so far this quarter. The S&P 500 is still down 4.74%. And also the NASDAQ composite down, more than 5.7%.
It's interesting. I've been doing the same, taking stock of where we have been this year so far. And while you see a lot of those S&P gains coming from communications, tech stocks, you also see a lot of it coming from energy. So you really have the market telling you two things at once. One, that they're worried about kind of geopolitical risks and really pushing into that energy sector at a bigger scale, while also having some optimism around that technology sector where, again, the rules we've been talking about are being rewritten in terms of how those giants are willing to give that money back to investors.
Though it was interesting, one contrarian point to that was that note out of Jonathan Golub over at UBS, basically cutting to neutral his sector recommendation on those big 6 tech firms, basically the Mag 7 minus Tesla here. And he says, look, those longer term narratives on AI, et cetera, that's still in play, but he sees some difficult comps as well as some concerns here about cyclical forces that could actually slow some of that earnings momentum. We will find out in due time, about 24 hours from now, when Tesla kicks us off with those big tech earnings. Here on this day, though, a nice rebound from last week. They haven't recouped all those losses, but I think investors will take it. The Dow Jones Industrial Average up 250 points or 0.7%. The S&P 500 closing back above 5,000, up 43 points or 0.9%, while the NASDAQ is going to close out the day higher by about 1.1%. And the Russell 2000 and those cyclical stocks also getting in on the action. The Russell, the S&P 400 mid-caps, and Dow Transports each up 1% on the day.
All right, guys. So earlier I mentioned pretty broad-based. If you look at the S&P 500, almost all the names, 412 to the upside for the Monday trade, Sonali, 86 to the downside, 5 unchanged.
Let's look at the sectors here as well, because it's interesting. You are seeing outperformance here in information technology up about 1.3% on the day, and financials getting some love around 1.2% on the day. You're also watching materials really lag the group, but still in the green, only up about 0.2%. But again, broad-based gains today across the S&P.
All right, so let's get to some of the individual gainers. A fair amount to choose from, certainly, in today's session. Your number one gainer in the S&P 500, folks, is Ford Motor Company. That stock just finishing off its best levels of the session, so that's good for a gain of about 6.2%. What we saw is legacy automakers actually rallying in today's session, while some of the EV makers came under pressure following some news that Tesla is deciding again to cut prices, really slash them across their lineup over in China over the weekend. We saw GM also trading higher in today's session. Keep in mind that GM and Tesla both reporting tomorrow, and then you get Ford results on Wednesday. All right, another standout performer to the upside, NVIDIA. That went up 4.3%. It is the number 3 gainer in the S&P 500, number 2 gainer in the NASDAQ 100. SoftBank is investing 150 billion yen, or just under $1 billion US, by 2025 to boost its computing power for generative artificial intelligence. This is coming from the Nikkei. They didn't say how it obtained the information, but nonetheless, and despite that call from UBS cutting their sector recommendation on the big 6 technology names, that SoftBank news really giving a boost to shares of NVIDIA in today's session. And then here's a healthcare name, Guardian Health, up about 9.5%, so finishing just off its best levels of the session, rallying after the FDA scheduled May 23rd an advisory panel to review the company's Shield blood test for colorectal cancer screening. So that really gave a boost to that name in the Monday trade.
Does that thing work? I thought that was like the whole issue. Everybody was concerned that it doesn't necessarily have the efficacy.
They're going to do a test for an advisory panel, so it looks like they're making some progress there, Romaine. Okay. Yeah, we'll see.
All right. Well, you got the gainers, Carol. I got the decliners. I do want to start with Tesla. We talked a little bit about them in our program earlier. I know you guys did as well. The worst performer in the S&P 500 on a points basis, down more than 3% today. A slew of headlines. The company cutting prices in China, Europe, and the U.S. This coming at a time of slumping sales, a glut of inventory. Also slashed the prices over the weekend on full self-driving, the auto software here in the U.S. Musk postponing a trip to India, where he was expected to meet with the prime minister, saying had to deal with, quote, heavy obligations at Tesla. The company also, according to our reporting, and then confirmed by Elon Musk a little later today, slashing a newly formed marketing team. Check out today's big take. It's all about the chaos at Tesla. As you guys mentioned, the company reporting after the bell tomorrow. Down nearly 44% so far this year. Shares the lowest going all the way back to January of 2023. Let's take a look at what happened with Verizon today, down 4.7%. This after the company reported continued customer losses and lagging revenue. Free cash flow also falling short of analyst expectations. We should note the company did say that more people were choosing premium phone plans.
Premium, really? Did they talk at all about all the drop calls? I'm asking for a friend.
Okay, you are. The largest wireless carrier in the U.S.
Is that friend's name Romaine?
Informatica, the software company, shares finishing down by 10.5%. The company coming out and saying it's not engaged in takeover talks following reports that discussions with Salesforce had cooled. Salesforce's takeover talks with Informatica cooled, with both parties struggling to agree to terms. That's according to a person familiar with the matter. Salesforce and the data management company Informatica had been unable to agree on a price. The person said, asking not to be identified, discussing confidential information. Nonetheless, shares falling 10.5% today.
All right, let's take a look at the yield space right now. Maturities across the curve, relatively little change, at least compared to the big swings that we saw last week. Your 2-year, 5-year, and your 10-year all slightly lower here on the day, but only by about a basis point. You did see a little bit more selling on the long end of the curve with the 20 and 30-year yields and 30-year treasuries, and that pushed yields on each of those issues up by just about a point. Carol.
All right. So as we get ready for a jam-packed week, certainly some big earnings, as we've all been talking about. We have kind of some record treasury auctions coming your way, an important inflation print. One of the stories that is among the most read, it was even a red sticky earlier in the day about what Goldman's doing. Remember, they've been for years really trying to tap into the kind of regular guy and gal, if you will, consumer market. Well, they're ditching their robo-investing and they're selling it to Betterment. But, you know, Tim, you and I talked about this earlier. I mean, this is something that they've been trying to do for years, but they've been kind of slowly unwinding that. It just hasn't quite, the consumer play, at least that is, played out how they thought it would.
Yeah, we don't have details on the amount of the sale, and you know, our own Srinatharajan arguing that it's not material to Goldman.
But isn't that kind of the key though? When you say it's not material,
yeah,
it shows you just how much this has failed.
Remember how big of a push they made into consumer banking over the last few years? They had the huge tech acquisition a few years ago that brought over, I think it was called Clarity Money years ago, and they've been spending years unwinding that.
Well, one big question that remains is they still have Marcus, and Marcus has those savings accounts, and recently they reduced the interest that they are paying out on those accounts for the first time.
I'm sorry, they reduced the interest?
They did. And so in anticipation of rate cuts, they cut their rate.
What do they know that we don't know?
Well, here's the thing. So if they don't have Marcus Invest and these other products drawing in consumers, then do they still get to bring in that money, which ultimately is to lower their cost of deposits for the firm?
So is this, I mean, Chanel, you cover this company, but is this kind of the end of that retail push, or is this just kind of maybe a reset?
Well, that's the thing. They still have Marcus, right? They don't have Marcus Invest, but they do have Marcus. And
but
so
how big is that right now, though?
Marcus, the actual, I mean, it's still quite sizable, right? I mean, they bring in a lot. Remember, they had the most competitive rate next to essentially SoFi and a few others in the market since the start of the rate hiking cycle. But does that continue without all of these other ancillary things?
Well, that's what I was going to ask you. And sorry, we're turning this into a let's ask Shanali a lot of questions. But why keep it, Shanali? What is it? Is it just that it brings in another round of kind of money that they can play with a little bit? Is that what it's all about?
It's not even playing with that money. It's the idea that it lowers their cost of deposits, right? I mean, that's kind of why these banking businesses are able to do so well by bringing in essentially stickier money, if you will. Remember, it's not just that they have money in savings accounts for markets. They have CDs that are locked up for some period of time. And so, again, do they keep that as a strategy ultimately to keep their costs lower?
But it's definitely a scaled back strategy, right, in terms of kind of going after consumers. All right, guys, that's a wrap. Get ready for a really, really, really big week this week. It's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it Beyond the Bell, and we will see you again, same time, same place tomorrow.
And our coverage continues right here on Bloomberg Television. A push ahead to the impact geopolitics is going to continue to have on the markets. We're going to have the latest from a report out from Nathan Sheets, global chief economist at Citi. That's on tap right after the break. This is The Close on Bloomberg.
Welcome back to The Close. I'm Shonali Bassick.
And I'm Romaine Bostick. And what a difference a couple of days can make. We talk about that big sell-off that we saw last week in U.S. equity markets, really global markets to be sure. Well, right now, investors trying to get their mojo back, pushing up the S&P 500 back above that 5,000 level, up about 1% on the day. The NASDAQ did a little bit better here on the day as big cap, big tech did get a bid, and that's ahead of a big week for big cap tech earnings. About 150 or 160 S&P companies are scheduled to report earnings this week, Shonali, and that includes the big names like a Microsoft, like a Alphabet, like a Tesla, and quite a few others that I'm forgetting.
Yeah, a lot is on the line here, and interesting, if you saw what was moving today, it's none of the companies that have yet reported, but Ford, the biggest gainer in the S&P 500, up more than 6% on the day, bet on America and the American driver there. NVIDIA up more than 4.3% on the day. What's interesting there is it recovered slightly from its 10% and so sell-off on Friday, but NVIDIA also here, Romaine, one of the biggest gainers on the day in the S&P.
Absolutely here, and of course, the top. All right, well, let's continue this conversation right now. We talk about sort of some of the broader issues going on in the market, whether it's Ukraine, whether it's Gaza, to the upcoming U.S. election. There really is no shortage of geopolitical risk out there that could upend markets and the economy. Here with Citi's latest report on that topic is Nathan Sheets. He's the global chief economist over at Citi. All right, Nathan, I think over the last couple of weeks, investors really had a little bit of a wake-up call that the fact these geopolitical issues are still floating around out there. Kind of give us the cliff notes right now. When you sort of look forward and you guys are strategizing here, should we expect this to persist?
I think the key issue at the moment is what does it all mean for the oil market? And I think if there's any good news to be had, is that the oil market has today taken the Middle East stresses more or less in stride. I think the markets are calculating the risks and kind of bottom line are in a place where they're saying this is probably not going to escalate into a broader regional conflict. Now, as I say that, we've also seen over the last week or so another stylized regularity that often persists with geopolitical risks, and that is initially the markets tend to overreact to the shock. Mm-hmm. So when the shock comes, there's a big move, let's say in the oil market, and then it abates. And that overreaction we've attributed to an uncertainty premium. And that's really the key here. We think we know a baseline with geopolitics, but it's the uncertainty and the tails around it that keep us up at night.
I am curious when we talk about that uncertainty, and I know when you're dealing with wars and some of these big humanitarian issues, it's incredibly difficult to try to game that out as to how that's going to affect financial markets or the economy. But there are sort of hedges. There are sort of ways that investors can at least protect themselves or be ready to protect themselves. When you look at this market right now, do you see that type of protection or at least that type of readiness should that black swan appear?
It's a very interesting question. And indeed, in our report, we looked at possible hedges. And pretty much at the top of our suggestion was gold. And when you look at the gold price and think about where it is, I think there's an inflation story and protection against inflation, but there very well may also be a geopolitical story there as well. So, maybe to some extent we do see the markets and investors taking some of those precautions you'd expect to see during a period of elevated geopolitical pressures.
How do you think about this in terms of the dollar as well, Nathan? You've seen that haven bid come in there as well. And of course, there's a relative strength story. But what about just the pure play thinking around how the U.S. dollar moves from here?
I think, as you suggest, the dollar is a safe haven, and likely some of that is in play in terms of thinking about the underlying strength of the buck in this circumstance. I think underneath it, it's reflecting the resilience of the U.S. economy. And we've seen that again and again. And, compared to many other parts of the world, the U.S. continues to be quite resilient. And as a result of that, the Fed relatively aggressive. So when I think about the trajectory of the dollar going forward, it's really hard for me, say, over the next 6 to 9 months, to give you a narrative where the dollar, notwithstanding the fact that I see it as being quite strong in broad, real, effective kinds of terms, I think the dollar is likely to remain where it is. And if anything, maybe a little bit of pressure toward further appreciation over that kind of a time period.
It's interesting. Citigroup has really kind of been at the forefront of this deglobalization idea, or, the limitations thereof. And if you think about the trades that have been kind of secular, playing out over a number of years, what trades do you think really still have room to run, given kind of this idea that tensions are brewing around the world and people are looking to nearshore?
Yeah, I think that deglobalization, the front and center argument there is that we are seeing a pulling back and reprofiling of global flows, of global economic activity away from China. And it's going into other places and other regions. And I think some of the beneficiaries of that have been India and perhaps other parts of Asia as well. I think Mexico has been a big winner. And arguably, we're seeing some nearshoring in Mexico and reshoring in the United States. Kind of putting all that together, I stay pretty optimistic about the medium-term outlook for some of those places, some of those regions and countries that are benefiting from this move away from China, which I think is likely to be sustained and structural and ongoing for yet a number of years.
It certainly is. And it gets to the broader question, too, Nathan, as to does that make China, at least from a U.S. or foreign investor perspective, less investable, or is that just kind of going to change maybe the dynamics of what ends up being attractive there?
So I think there are two kinds of factors that are in play in this reprofiling away from China. The first is very much a geopolitical premium, where investors have to think about the geopolitical environment and, for example, the possibility of tariffs. And I think that increases the risks associated with investing in China and being exposed to China, say, in a supply chain. But the other kind of risk that's really emerged over the last several years is that during the pandemic, we saw broad classes of economic shocks that we hadn't previously seen, and particularly with respect to supply chains. We had thought previously that global shipping would be reliable, efficient, and cheap. And we saw challenges to that in the pandemic that we'd never seen before. So I think there are both economic and geopolitical factors that are kind of encouraging firms to reprofile their sourcing and in some cases bring them closer to home and consolidate or at least reduce the vulnerabilities in their supply chains.
You know, it's interesting, Nathan. I think back to what Ruchir Sharma has written in the Financial Times over the weekend here, the overstimulated superpower. At what point do you look at kind of where rates are going in the United States and saying this is becoming a problem for the rest of the world, the strength of the dollar as well?
I think that's absolutely right. As the dollar strengthens, that creates some challenges for the United States and for U.S. manufacturing. But we're seeing in some other countries, the weakness of the currency is also creating problems. And I think front and center on that list is Japan, where the weakness of the yen is increasingly a significant political and economic issue for the Japanese policymakers. And specifically in Japan, they've got to import all their commodities. And when the yen weakens to the point that it has, it's quite expensive. So really what policymakers want is currencies that are in a range of kind of where they've been historically normal, and also currencies that are reasonably stable. And what we have now is kind of an exaggerated pattern where the dollar's quite strong and the yen and some other currencies are quite weak.
All right, Nathan, great stuff. Always wonderful to talk to you, and an interesting report out by Citi. Nathan Sheets there, who helps lead their economic team over there. And Sonali, we do want to get you some earnings that actually just crossed the wire. Some second-tier companies, but some big moves after hours. That includes Cadence Design Systems. This is the big maker of software to help design chips here. Its most recent quarter saw some pretty big misses, both on the EPS side and on the revenue side, with revenue dropping about 1.2% in the most recent quarter. But the guidance going forward, a big miss. Adjusted EPS, they're looking at a range of about 120 to 124 for the current quarter. The street was looking for $1.43. Cleveland Cliffs also moving lower on the back of a miss in the most recent quarter, as well as a miss on its guidance going forward. That company basically saying that its capital expenditures are going to come in maybe a little bit higher than expected, and its results for the most recent quarter, revenue down and adjusted EBITDA well below what the street was looking for. Meanwhile, Globe Life, which has been in the news quite a bit here, the life insurance company, oscillating between gains and losses here. Results coming in line in the most recent quarter, and the guidance for the year a bit mixed, seeing operating EPS at $11.50 to $12 a share. The high end of that range is higher than what the range that it given prior to today. All right, stick with us. Our top three coming up, where we focus on the top three movers and shakers at the center of the day's biggest stories. That's coming up next on The Close on Bloomberg.
It's time now for the top three. Every day at this time, we do a deep dive into the people at the center of today's top stories. And up first is Ray Dalio. The Bridgewater CEO's diversification trade is sputtering, and investors are bailing on risk parity funds. Romaine, these got really popular after 2008, but they have not kept up.
Yeah, well, I mean, anyone, if you want to know why, I mean, yeah, like I said, you just look at the performance and you see why. I mean, look, I mean, he was obviously the pioneer of this, and it worked for a long time, and a long time it didn't work. And I think the bloom has kind of come off that rose, and it's kind of understandable why you're seeing people just kind of move on, if you will.
And finance evolves. There's new ways to find those safety trades in this market these days.
Yeah, absolutely. Another person I'm keeping an eye on is potentially the next president of Mexico, Claudia Sheinbaum. She's the leading presidential candidate right now in Mexico, and she had a chance to sit down with Bloomberg and give us her view on the upcoming U.S. election. Here's what she had to say.
I think it will be good whether President Biden or President Trump wins. We have a very strong economic integration with the United States. We are now the principal trading partner, and that requires us to have a good relationship. Now, I think that obviously we are always going to defend Mexicans abroad. We are not in favor of any discriminatory discourse, but there is going to be a good relationship.
And Claudia Sheinbaum there, of course, the mayor of Mexico City. And at this point, based on the polling and the way the election's there, she pretty much appears to be the presumptive president once those elections actually go through.
And of course, with the own U.S. elections, a lot of questions about how the winds of trade may change. I'm also watching David Beckham, actually.
Is he running for president?
He is not running for president, but he has another bone to pick with somebody else. The famous footballer is suing Mark Wahlberg, once his buddy, after a brand deal with F-45 training that went bad. You have to remember here, F-45 went public at, I think, about $16. Yeah, $16 in 2021. And this was over delayed stock payments. Right now, F-45 is trading at really cents on the shares. It's really trading
it's like 15 cents a share. There was a lot of hype around this when it first came out. And I mean, I've seen these, I don't know about around the country, but certainly in New York City, they're kind of ubiquitous. But I guess, I don't know. I feel like the gym business is just so fickle and just hard to make money off of.
A lot of gyms having a hard time, and now a friendship gone awry over it.
Are they not friends anymore?
Well, they're suing each other, so I'm sure it's a little strange.
I don't know. I mean, sometimes good friends sue each other.
There's more in the Beckham world, I hear, these days, too.
All right, and we're just going to add one quick one, really quick here, to our top three, top four here. Just crossing the wire on ADM. We're now learning that Vikram Luthar who was actually on leave. We're now learning that he is going to resign on September 30th. Of course, the big accounting scandal over there that ADM is trying to work itself through. All right, stick with us. When we come back after the break, a look back at the Deepwater Horizon and the largest marine oil spill in U.S. history. And a question before we go to break. How many barrels of oil were spilled during the BP Deepwater catastrophe? The answer when we come back. This is Bloomberg. All right, time for a look at this day in history, and we go back to 2010. The biggest oil spill in U.S. maritime history unfolded as the Deepwater Horizon rig sank in the Gulf of Mexico. The incident began the day before when an uncontrolled rush of oil and gas surged out of BP's Macondo well, causing that drill pipe to buckle, ultimately preventing a blowout preventer from kicking in and sealing that well whole. The oil and gas ignited and the rig exploded, killing 11 people and initially leaving a sheen of oil on the water surface 1 mile wide and 5 miles long, a sheen that only got worse. For the next 3 months, 87 days to be exact, all eyes were on this underwater spill cam that streamed images of oil streaming out of that failed well. Transocean and BP, which at least the floating rig, tried to use remote-operated vehicles to shut the valves on the seafloor, but ultimately, they couldn't staunch the blaze. And that brings us to our question of the day. How many barrels of oil were spilled during the Deepwater crisis? The answer, 3.2 million barrels of crude oil in total, or roughly 135 million gallons, fouling thousands of square miles of water off the coasts of Florida, Alabama, Mississippi, Louisiana, and Texas, and it shut down much of the U.S. Gulf of Mexico to fishing and beach tourism for the rest of that year. It was a costly mistake all around. Researchers at the University of Florida estimate that in the 10 years following the incident, the spill cost more than 25,000 jobs, $2.3 billion in industry output, $1.2 billion in total value added, $700 million in labor income, and $380 million in federal tax and local tax revenue. In addition to BP itself, it had to agree to pay about $7.8 billion to victims and $4 billion more to resolve criminal complaints. And that's on top of $21 billion to resolve civil claims, under the Clean Water Act. Transocean itself was hit with $1.4 billion in fines and penalties. All told, though, the incident was really a reminder that the U.S. is still heavily dependent on deep water drilling. The Energy Information Administration says that as of January, oil production in federal waters in the Gulf of Mexico alone accounted for 15% of total U.S. crude production, or around 1.7 million barrels a day. That's slightly higher than the roughly 1.6 million barrels that were being produced just prior to the Deepwater accident, and above the roughly 1.2 million barrels a day coming out of the North Dakota oil fields.
And Romaine, we're going to talk about today's Bloomberg big take now, because Tesla, consumed by chaos amid CEO Elon Musk's shift to focus from a new, cheaper model to the robotaxi. Let's bring in Bloomberg's technology host, Ed Ludlow, for more on this story, because, Ed, the negative energy going into Tesla's earnings report here is quite palatable. You've had Tesla falling for 7 straight days. You have had, over that period, more than $100 billion wiped out of its market cap. What can investors look forward to as they paint the path forward?
They can look forward to wartime CEO Elon Musk. That's kind of his mentality right now, I'm told. It's an earnings call, probably one of the most important in the company's history, where everyone, whether you're a retail investor, a Tesla vehicle owner, a giant of Wall Street, wants some clarity about what the plan is here. We tried to do that in the big take. I think we've given a lot of pretty granular information about it is Musk that is directing this pivot to a robotaxi, but the $25,000 cheaper EV is not completely dead. The messaging has been very horrible, frankly. And at the same time, you have this kind of big layoff exercise, which is a negative headline. So it's a lot to understand. We get to hear from the man himself.
Well, I mean, kind of break this down, though, for us, Ed, because, there are a lot of people that look at some of the troubles that Tesla has had over the last couple of years and say that a lot of this is directly tied to decisions that Musk himself made, whether it was the Cybertruck or a few other things here. When it comes to them articulating a strategy here, how much is that strategy going to differ than I think what we've heard in the past, particularly given the fact that all the things investors said they wanted, Elon seems to be, at least for right now, kind of saying, no, that's not it.
Yeah, my understanding is that it is Elon Musk himself putting a real focus, all of his emotional and physical energy into a robotaxi. And that is in the face of other Tesla executives pleading with him to say, please do not abandon this 25,000 EV model. For the institutional investors, having a mass market affordable car at a $25,000 price point was a big part of the bull thesis. They thought it would solidify Tesla's lead in this market. And I think Elon has been away, very focused on his other companies, and now come back and said, I don't like what I see. So I am doing this. I am doing robotaxi, again, against the advice of other executives. And we've seen some of those executives leave the company as a result.
Ed, when all was well and good with Tesla, when the stock was flying high, the distractions, if you will, or the side companies that Elon Musk was involved with was less of a problem. Are investors convinced that he is no longer distracted?
I think investors are just, again, looking for clarity. Elon Musk is often late to the timelines that he presents, but he often does get there in the end. The problem is that the classic levers that he has utilized before, layoffs and price cuts, have kind of hit their utility, right? Tesla's continued to cut prices, but as we learned in the first quarter, inventories are starting to build up, and it is not immediately unlocking pockets of demand. Traditionally, when a company does layoffs, it's often cheered by investors, but I think this time around, these continued layoffs and the depth of the layoffs has got others concerned that it's just further evidence of how tough the environment is for Tesla right now, which again makes the earnings call the more important to kind of see what the path forward is.
All right, Ed Ludlow there, the co-host of Bloomberg Technology, and we want to continue this conversation right now with Seth Goldstein, equity strategist for energy and resources over at Morningstar. And Seth, I just want to start off here with the lower priced car, because so many investors had really believed in Elon Musk and this idea that they were going to develop this lower priced car. There are a lot of people that look at the market share being lost in China as a direct result of not having a lower priced car. When you look at what customers want and the trends and the way that that's been moving here, is there a market for a lower priced EV?
I think it's a pretty big market. When we look at the auto market in general, most people have somewhat of a price limitation on how much they can spend. And so when you're looking at electric vehicles, especially in markets like the US and Europe, being largely limited to luxury segments, that limits the amount of EVs that can be sold just naturally based on not having the availability of lower priced models. So even if Tesla does not want to compete in China, where the affordable vehicle market is seeing a massive price war going on among new EV entrants, they would still have solid demand and likely good margins in the U.S. and Europe for an affordable vehicle.
Well, that's what I'm trying to get at, too, because if this is a strategy about just being more in the luxury end, or if Elon Musk just really sees a greater opportunity in robo-taxis, and that really remains to be seen, given that no city has actually approved these. But can they be, I guess, a more higher end, meaning higher price vehicle and still grow that business at a level that's going to satisfy investors, or is having a more affordable option pretty much critical?
Well, I've always viewed Tesla's vehicles as increasing the total addressable market for the ancillary products and services, which can drive much higher profits. So every car sold is an extra car that can get a full self-driving subscription at a very high margin to Tesla, get insurance in a growing number of U.S. states, and can utilize Tesla's charging networks. And so I've viewed Tesla entering in the affordable vehicle market as increasing the entire company's total addressable market and therefore being able to grow profits. But if Tesla decides it just wants to be a luxury automaker and cut its total addressable market, then if Tesla wants to continue to generate high profit, high free cash flow growth, it would need to develop the full self-driving software and license it out to other automakers. And at that point, pivot to being more of a software provider as the main business. I'm not sure if we're going to go there tomorrow, but it'll be interesting to see what Elon Musk says is the strategy for the company, not just in the next year or two, but over the next 3, 4, 5 years, if that has changed at all, where they're focusing.
Given what we already know, Seth, how much more downside risk is there to the stock on the heels of earnings, given we've already seen a more than 40% sell-off this year?
Well, if investors no longer believe in a lot of the bull case and a lot of the upside, then it's possible we see the stock sell off back to the levels in early 2023 when it was at around $100 a share or just above. If investors start to look at Tesla as just another automaker who sells luxury vehicles and not giving them credit for restoring margins, not giving them credit for these ancillary businesses and the profit growth there, then I think we start to see Tesla look like other automakers as far as the valuation is assigned, and we could see the stock continue to trade lower. But if Elon Musk can assure investors that there is a solid strategy in place to restore profits and free cash flow, then I think the market could be a little alleviated and we might see shares rise again.
What brings Tesla to your price target? We're about $50 or so off. If you think about any positive headwinds at this point, given all the negative sentiment that's been brewing around the stock, how does it get there?
Well, I think it's a couple things. First, we need clarity on the affordable vehicle. If it's just delayed by a year or two, but they're still planning to build it and it's still going to be a new market that they're going to aggressively pursue, then that would take up the total deliveries in the second half of the decade and as we get into 2030. And then I think that starts to give the market more confidence that Tesla can still grow deliveries. Second, what's the progress on full self-driving? And it would be great for management to give us some numbers around this. How many subscriptions do they have? What's the revenue contribution? And I think once we start to see that, and third, cost reductions. I want to see the plan they implemented last year in the March Investor Day. How has that started to affect margins? If we see margins stabilize or even slightly rise throughout the year, then I think that assures investors that we've reached the bottom of the margin decline, and we could see Tesla start to increase margins in the future. So I think that's how we get there to a higher price, higher deliveries, lower costs, stabilizing margins, and then an update on full self-driving, generating additional profits and free cash flow.
And just final question here, Seth. There was also a lot of talk about Tesla's marketing spend, or rather lack thereof. There had been some discussions that Tesla was going to sort of enter in the ad space, and now we're actually learning that, at least based on some comments Musk made, maybe not quite yet there. Do you think they need more of a marketing strategy other than just Elon Musk being this sort of effervescent presence everywhere?
I think it could certainly help to showcase that Tesla is still offering some of the highest tech EVs out there on the market. If Tesla is looking at just general EV advertising from its competitors as growing customer awareness of the EV space, I think they're a little late. They need to start to make the case for why someone should pay up for a Tesla, why Tesla still offers the best technology, and to do so, they need to do a little more than just tweets and Elon Musk making statements. They need to run some actual advertising. And I think that could help, make consumers more aware of the value that they're paying for when they're paying up for a Tesla.
Yep.
Seth, thanks a lot for your time. That is Seth Goldstein, Morningstar equity strategist for energy and resources, ahead of course, a busy day of Tesla earnings. But we're first going to take a look at some earnings.
Did you buy one of these Cybertrucks?
I've been living in New York for a while, man.
Yeah.
no cars from me over here.
Yeah, okay.
But Romain, let's take a look at these earnings because it is remarkable. You do see a lot of optimism in the S&P today, but aftermarket Cadence Design Systems now down about 9%. Of course, this is a software-linked company that's about $77 billion in market cap. You also have Cleveland Cliffs now down almost 2.4% after market. Of course, what interests me about Cleveland Cliffs is not just the earnings, but what's going on in the steel industry at large in the United States. That negative energy aftermarket. Globe Life first up aftermarket, now down more than 0.5%.
And I'll just point out on the Cleveland Cliffs, we also got Nucor earnings that were just out here. Those shares down about 6% in after hours trading here, despite the fact that at least on the top and bottom line, it looked like they beat, but they're providing some guidance going forward that shows a decline in 2Q from 1Q.
Messy tape out there. We're going to keep an eye on it after the market and, of course, into tomorrow. But this is, for now, the close on Bloomberg. Now, tomorrow, the Senate is poised to vote on a foreign aid package totaling $95 billion, which passed the House this weekend with the help of Democratic support. Let's bring in Balance of Power co-host Kailey Leinz to talk about the setup here. I think the actions over the weekend really spoke wonders. It spoke loudly in terms of the changing dynamics, particularly of the Republican Party as it related to the Democrats here.
Yeah, Sonali, it took us months to get to this point. There has been a long-standing debate over whether or not the U.S. was going to continue to provide aid to its allies. What ultimately made it possible to get it through the House was dividing this package up so that members could vote on each package individually, saying no to some perhaps while saying yes to others, which is why on the Ukraine vote, while Ukraine aid did pass, you had a lot of Republicans who would not vote for that aid while they were able to vote for Israel and aid for the Indo-Pacific, et cetera. And then, of course, the sidecar package that included the TikTok divestiture ban bill as well as repo, which is taking frozen Russian assets and using it potentially to fund Ukraine's war effort. That has gotten all put together now into one package that will have to pass the Senate. The first vote will be tomorrow on cloture. That's essentially a test vote that is needed to proceed forward. Assuming they get 60 votes needed to limit the debate, it'll be a maximum of 30 hours of debate in the Senate before it will pass this bill. So we're talking either mid-late Tuesday, potentially latest early Wednesday that this will get across the finish line, get to the signature of President Biden, who spoke to Vladimir Zelensky, the Ukrainian president, today and said aid will roll out quickly once he's had a chance to sign this bill.
One of the more intriguing things that occurred, of course, over the weekend was just how much support the Republican leader, Mike Johnson, was able to get from fellow Democrats here. And as of right now, Kailey, 4:48 Washington time, he still has his job. He hasn't gotten McCarthy yet. What's going on?
He still has his job, Romain, but the House is on recess this week. So we'll see if he's still sitting very comfortable when they return next week. But to your point, obviously the threat is still hanging out there. Congresswoman Marjorie Taylor Greene has suggested she could act on the motion to vacate. She has two other Republican members joining her, Tom Massey and Paul Gosar. They all over the weekend were talking about this idea that Johnson should resign before they actually would force a motion to oust him. Johnson has said he is not going to do that. So we'll see whether or not he ultimately calls the bluff. But yes, we have heard from a number of Democrats, including two that I spoke with just last week, Congressman Ami Bera of California and Adam Smith of Washington, both of which said they view Johnson as having done the right thing here, getting this aid across, working with Democrats in a bipartisan manner, and they do not think he should lose his job for that. So they may act to protect him if and when the time comes, Romain.
Yeah. Okay. Well, we'll see, Kailey. I mean, that was all I was intrigued about. I was like, okay, can he survive it? And he seems like a new man. He's like, I'm a Reagan Republican now. We need to help Ukraine and everything. I don't know. I guess he's had his come to Jesus moment, figuratively and literally. You can catch Kailey Leinz coming up at the top of the hour, along with Joe Matthew, the co-hosts of Balance of Power. All right, stick with us here on The Close. We're going to set you up for what to watch over the next 24 hours. This is Bloomberg. Some breaking news just crossing the wire here on the Bloomberg. We're learning now that the FTC here in the U.S. has formally filed that lawsuit to block the Tapestry merger with Capri. John Edwards joining us right now, who helps to lead our consumer coverage here at Bloomberg. And John, we reported last week that the FTC intended to do this. We're now learning that that lawsuit has been filed.
Exactly. It looks like they have some concerns about excessive concentration in the affordable luxury market, which both companies play in. So, the companies, though, think they have a pretty good case that the market is more fragmented than the government believes. So we'll see how it goes.
All right. Well, of course, we'll try to get you some more details on what's going on with that merger, and particularly in the luxury space. But we actually brought you on to talk about something a little bit more pedestrian. Yeah. We're going to get PepsiCo earnings tomorrow morning. A closer look at consumer staples, though. I think for some people, they would say some Pepsi products are more than staples or necessities here. What are we expecting? I saw organic growth supposed to be like 2% or so.
Exactly. Yeah. It looks like a bit of a slowdown against the tough comparison from last quarter or last year, rather. It was 14% in the year ago quarter. So going to pull back from that, to be somewhere between 2 and 3% on organic revenue growth. But it also, it looks like they're maybe running into some headwinds with their sales of salty snacks, which the Frito-Lay side has been a real strength for them. Yeah. And that seems to be slowing down a little bit.
Right. What's the bigger issue here? Anything like inflation or macro, or actually just consumer preferences given the Ozempic effect?
Yeah, I mean, we'll see if they make any comments on, whether that effect is actually showing up. But I think they've got, some currency issues as well. And of course, inflation, is not going to be helping anyone. So.
Yeah, and of course, everyone will ask them probably about Ozempic and those weight loss drugs and how it's affecting them. John Edwards to help to lead our coverage here on the consumer side. Those Pepsi earnings scheduled to come out tomorrow morning. We will have full coverage right here on Bloomberg tomorrow morning as all of those earnings cross. There's also quite a few other events to keep an eye on here at Bloomberg. And we're going to start off with Jamie Dimon, scheduled to speak at the Economic Club of New York. Sonali.
Yeah, it's going to be interesting because we've heard some of what he had to say about his concerns about the environment here. But let's see if anything is changing because, of course, we have a Fed meeting just next week, and we know he is guided higher for longer.
Yeah, and of course, when Jamie Dimon speaks, people listen, of course, and he has a lot of great opinions here about where the economy is going. And speaking of the economy, we do get some economic data tomorrow as well, Sonali.
Yeah, we have new home sales. We actually also have PMI data tomorrow to look forward to, and we didn't see that much of a move in the bond market today, but tomorrow's a new day, isn't it?
Yeah, we're also going to get some manufacturing data. So you're kind of going to get potentially a lot of potential catalysts for this market, from Jamie Dimon speaking to some of that economic data. And then, of course, we also have earnings and quite a few important ones. We just talked about Pepsi, but a few others as well, Sonali.
Yeah, there certainly are. And after the bell tomorrow, Tesla is one that everyone's going to be watching very, very closely. But we also have UPS, GM, Spotify, Lockheed Martin throughout the day as well. And Pepsi, as we've been talking about. JetBlue, you've been talking about those transportation stocks, if you will, getting some love outside of Tesla.
And what I love about that board up there is that you really get a nice cross-section of the economy, right? I mean, we start off earnings season, it's just banks. Then you get a couple of tech names, but you get much more of a cross-section, so you learn about what's happening with consumer spending and, of course, what's also happening in corporate spending as well. And then, of course, I don't know where Tesla falls, but, of course, that's just the Elon Musk show.
What do you have against the banks, for me?
I don't know. I know. Sorry. I know. Sonali, don't hurt me. Anyway, the banks provide a lot of insights, of course, as well. Join us tomorrow. Sonali and I will be back right here on The Close. Full coverage of all the earnings that we just talked about. And for all your political coverage, stick around. Balance of Power is coming up next right here in the U.S. Kailey Leinz and Joe Matthew on tap at the top of the hour right here on Bloomberg.